The first person I caught up with here at the Ideas Festival in Aspen was Niall Ferguson. You'll remember he is the Harvard professor of economic history and author of books including The Ascent of Money and most recently the acclaimed High Financier, a biography of revolutionary banker Sigmund Warburg, the father of the Eurobond. Now, Niall may be a historian, but what he does best is explain the unpleasant truth about today's economy. Here he is on bond vigilantes and the U.S. Treasury market.
Well, bond vigilantes are a bit like the people who were short-selling investment banks a couple of years ago. You work down the list in order of the parlous position. You know, you start with Bear Stearns and Lehman Brothers. You don't get to Goldman Sachs until quite late in the game. And in a way, the sovereign debtors of the Western world are pretty much in that position today. And we're working down the list, starting with Greece, moving on to Spain and Portugal. The UK kind of dodged the bullet by implementing some preemptive measures. Sooner or later, maybe after Japan has felt the pain, the bond vigilantes will get to the United States. I don't think it'll be this year, because the worse things get in the Eurozone, the more attractive US Treasuries look. But in the absence of any political will to address this problem, and the latest numbers from the Congressional Budget Office should scare everybody in this country, this is simply an inevitability.
There ever been a time in history when a massive accumulation of debt at low yields, what we're seeing here in the United States, hasn't been followed by a sharp increase in borrowing costs and the inevitable consequences?
It's impossible to find an example. The only country that grew its way out of this kind of a debt burden without inflation, without default, purely relying on growth and primary budget surpluses was Britain after 1815. But Britain after 1815 had two big advantages. It had the only industrial revolution at that point that was going on in the world, and it had the world's biggest empire. I don't see anybody in that happy position today. So we really have, at this point, a kind of choice before us. Is it going to be inflation, or is it going to be default? Right now, what's really troubling is that there's no sign of inflation, which is the easy way out of a debt burden in the United States. On the contrary, we have monetary contraction at a really quite alarming rate, and effectively zero inflation in terms of core CPI. So the option of inflating this debt away, which a lot of people think will be exercised, doesn't seem to be there right now. What you're left with is therefore default. And I think it's a fair bet that the United States will default, at least on the unfunded liabilities of Social Security and Medicare, at some point in the foreseeable future. What the Greeks discovered, and indeed they're not alone in this, is that you're fine until you're not fine with the bond market. And if you have a non-credible fiscal strategy of borrowing $1 trillion a year for the rest of time, never ever again running a balanced budget, and remember that is US fiscal policy right now, at some point the markets are going to get spooked. And I think that point is nearer than Paul Krugman believes. Indeed, I think nothing would spook the markets more than for Paul Krugman's advice to be accepted by the Obama administration, and for you and I to be reading in tomorrow's papers on Bloomberg headlines, massive new fiscal stimulus promised by the US government. That might well be the trigger.